There are a lot of tricks investors have come up with in order to speed up their journey to financial independence. We've covered several of them on this channel already, from cash buffers and flexible spending budgets to the use of financial guardrails once you've reached FI. And while the ability to sustainably raise your savings rate is still, far and away, the most effective method to speeding up your journey to financial independence I've ever come across, there are some who also utilize the switch approach to investing. The switch approach is pretty simple to understand. It's basically just investing one way during the accumulation phase of your financial journey, when you're still adding money to your retirement nest egg, and then switching to a different investing strategy once you decide to enter the drawdown phase of financial independence. The idea is that when you're working and earning an income, you're less likely to find yourself withdrawing money from your nest egg when it's down due to a market crash than you are when you've entered the drawdown phase of your journey. Therefore, things like short-term volatility and, depending on your personal risk tolerance, even the frequency and depth of market downturns becomes relatively less important than something like long-term growth. So at least in theory, during those working years, you can put more money into investments like stocks without needing to worry too much about the impacts of downturns. However, since the volatility and the proclivity for downturns of our nest egg does have a substantial effect on our safe withdrawal rates during the drawdown phase of financial independence, investors will often switch their asset allocation to something more consistent and tranquil as they get ready to enter that phase of their journey. And in large part, this is fairly sound thinking. We still do need to take into consideration how we'll handle those downturns during the accumulation phase if we should lose our incomes during them, but with proper preparation, this can do a little bit more to speed up our journey to financial independence. However, it is not necessarily the ideal approach for everyone, and that's what we're going to be discussing today. Let's talk about how the switch approach to investing can speed up our journey to financial independence and what other options are out there for those willing to explore them. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So let's say that John and Jane are 25 years old. They take home a combined $60,000 a year and are trying to decide between two different investment strategies: an all-stock strategy composed entirely of an S&P 500 index fund, and a 60% stock, 40% bond strategy consisting of a total stock and total bond market index fund. Both strategies can be viable for the right people, but John and Jane want to choose the strategy that'll allow them to reach financial independence the quickest, while simultaneously allowing them to live as luxuriously as possible once they've retired. In other words, they want an investment that'll deliver high returns with minimal downside risk, and boy, don't we all want that. But this is a bit of a conundrum, as history suggests that when saving up for longer-term goals like retirement, the all-stock approach will, more often than not, provide higher returns, and therefore get them to the savings goal quicker. However, it's also much more volatile in the short term than a stock and bond mixture. Therefore, it tends to not sustain quite as high of withdrawals once you reach financial independence. To put some actual numbers to it, based on the yearly data set that I have for these two strategies going back to 1927, assuming John and Jane's expenses changed in line with inflation, as measured by the CPI, the all-stock strategy would have maintained a minimum safe withdrawal rate of about 3.68% over any 30-year period, before taxes and expenses are factored into the equation. The stock and bond mixture, on the other hand, had a minimum safe withdrawal rate of 4.01% under those same assumptions. So if John and Jane wanted to live on that same $60,000 a year that they do now while they're working, then based on that information, they would need a nest egg valued at approximately $1.63 million using an all-stock strategy, and a little under $1.5 million using the stock and bond approach. Now, that may not be an absolutely earth-shaking difference, but it is a cool $130,000, so it's nothing to sneeze at either. Assuming John and Jane saved 15% of their income, history suggests that it would have taken anywhere from 34 to 73 years to amass that kind of wealth on an inflation-adjusted basis using an all-stock strategy, and anywhere from 86 to 89 years using a stock and bond mix. With a 30% savings rate, we're looking at a range of 21 to 54 years for the all-stock portfolio, and 31 to 74 years for the stock and bond mix. So it seems like it's pretty safe to say that, based on the historical data that we have anyway, and the assumptions we're using, John and Jane would be better off going with an all-stock portfolio while they're building up their nest egg, and then probably switching to a more balanced stock and bond mix when they're getting ready to retire, since that switch approach will allow them to reach FI faster in most cases, and allow them to withdraw more once they've actually retired. In other words, they could have their cake and eat it too. That's the basic idea behind the switch approach to investing for financial independence. And if history is anything to go by, it does seem to work. For instance, here's a table showing how often John and Jane would have reached financial independence, as well as how long it would have taken them on average and at the extremes, assuming they invested in an all-stock strategy during their working years versus if they had just stuck with either the all-stock or the stock and bond mixture from start to finish. As we can see, the switch approach matches or bests both the all-stock and mixed approaches at each level of savings in every metric. And in some cases, it's by a noteworthy amount. At a 15% savings rate, the switch approach reaches FI nearly 3.5 years faster on average than the all-stock strategy, and obviously decades faster than the mixed approach. The gap does narrow as the savings rate increases, but that's understandable, because in those situations, the money that you're investing each month is playing a much larger role in the growth of your net worth, and at the same time, you're proving that you're capable of living on less. I mean, if you're earning $60,000 a year and saving 15% of it, that suggests that you're spending roughly $51,000 a year, or 85% of your income. If you're saving 70% of your income, it suggests that you're spending the other 30%, or roughly $18,000 a year. In the second example, that probably means you don't need quite as large of a nest egg to sustain your lifestyle in retirement when saving money is no longer part of your overall budget. So it would make sense that the performance of your investments wouldn't create quite as large of a gap as they do with lower levels of savings. Now, I could leave it at that. I could just say that based on history, it seems like investing in a high growth but comparatively more volatile portfolio during your working years and then switching to a more balanced allocation as you prepare for retirement would usually result in faster paths to that retirement without any noticeable decreases in retirement income, particularly at lower savings rates. But it's not the only strategy that one can use to accomplish this goal. And depending on your situation and what you're willing and able to do, it may not even be the best. Because if you're willing and able to utilize techniques like financial guardrails, cash buffers, and flexible spending budgets in retirement, then you may be able to improve on the figures we just went over for the switch approach. This does depend on how far you're willing and able to go with these techniques, of course, so you'll want to run your own numbers to see if it's something you want to implement instead of the switch approach, but here is one hypothetical for how this could play out. Let's say that John and Jane were willing and able to live on the equivalent of 2.4% of their nest egg in the years where their investments were at least 20% below their all-time highs. For a $1 million nest egg, this would be about $24,000 a year. At $1.5 million, it'd be about $36,000 a year, and so on and so forth. We'll say that they had a cash buffer equivalent to 2 years worth of those survival expenses, and it was earning 2% interest. They'll use that cash buffer to cover their expenses for as long as they can during those market crashes so that they don't have to take any money out of their investments when they're down. They'll also implement financial guardrails, which will adjust their annual withdrawals up or down by 10% if their projected withdrawal falls outside of the boundaries that they set, which we'll say is 20% above or below their initial safe withdrawal rate, whatever that rate happens to be. So if their initial safe withdrawal rate was 5%, then they'll check to see if their annual withdrawals each year are either more than 6% or less than 4% of their remaining nest egg. If it is, then they'll adjust that withdrawal by 10% to at least try and get closer to being back within those 4 to 6% boundaries. Under these new assumptions, our all-stock strategy would have maintained an initial minimum 30-year safe withdrawal rate based on historical data of about 8.31% before taxes and expenses. Our stock and bond mixed portfolio would have maintained a 7.64% safe withdrawal rate, which is less than that of the all-stock strategy. Since it also tends to earn lower returns over the long haul than the all-stock approach, historically anyway, these techniques actually nullify the advantages of the switch approach to investing. If John and Jane were willing and able to follow these techniques in this way, then history suggests that the best portfolio for them during their working career and in retirement would actually be the all-stock approach. Which is a little confusing on the surface, but it makes sense when you think about what these techniques are actually meant to do. Because when you get right down to it, there are a grand total of 2 reasons that people might run out of money in retirement. They either don't get enough growth from their investments to sustain their lifestyle, or their expenses rise too quickly for their nest egg to keep up. Sometimes it's a combination of both. There are a number of reasons that these 2 outcomes can come about, and unfortunately some of them are at least partially out of our control, such as unexpected and uncovered medical bills that sometimes come up. But those are the 2 reasons for running out of money in retirement, and these techniques help to ward off the worst effects of both. Cash buffers are there specifically to ensure that you don't have to withdraw your money from your nest egg when your investments are down, at least for a little while. This allows your nest egg to hopefully recover from that downturn and continue to grow into the future, unhampered by a significantly reduced base to grow from. Just as a real quick, real simple example of how much of a difference this can make, say John and Jane had a $1 million nest egg when they retired. In the first year of retirement, their investments fell by 50%, which is possible with some portfolios, especially those of the all-stock variety. Now their nest egg is worth $500,000, but they still need to withdraw money to live on, so they withdraw the $60,000 that they needed to live on and move on with life. But of course, after that withdrawal, their investments are now worth $440,000. The next year comes around and their investments haven't fallen any further, thank goodness, but they also haven't really recovered either, still being worth around $440,000. But John and Jane, once again, still have to withdraw money to live on, so they take the $60,000 that they need, reducing the value of their nest egg to $380,000, and move on with life. The next year, John and Jane's investments doubled in value, fully recovering from that initial crash. However, despite the fact that, at least on a price per share basis, John and Jane's investments have totally recovered all of the losses they suffered in that first year, the nest egg itself is only valued at $760,000 before their next withdrawal. This is because the base that their nest egg was growing back from when it rebounded was only $380,000, which was quite a bit lower than it would have been had they used a cash buffer to cover expenses during that 2-year downturn. If they had had a 2-year cash buffer to get them through that downturn, their nest egg would have fallen to $500,000 after the crash, it would have stayed there in the second year, and then in the third year when it recovered, it would have gone all the way back to $1 million. And as you can imagine, due to the effects of compounding interest, that difference between the $1 million portfolio and the $760,000 portfolio would only grow as time goes on. Flexible spending budgets, i.e. deliberately lowering your spending during downturns, or just when you want to set money aside for something big coming up, or just when you feel that your spending is getting away from you, further exacerbates this positive effect. Financial guardrails directly target the lifestyle creep aspect of retirement expenses by ensuring that they never grow so large relative to the size of your current nest egg that you run the risk of outliving your money. So there you have it. Based on the historical data we have, it does seem as if switching up your allocation when transitioning from the accumulation phase to the drawdown phase of financial independence can work. You should still certainly take into consideration how you'll handle that higher level of volatility during your working years, as well as those extreme crashes, especially if you should find yourself thrown into a forced but temporary drawdown phase, i.e. you lose your job. But assuming that you're able to comfortably invest in both allocations, it can certainly speed up your journey to financial independence, with little to no impact on your ultimate income once you've retired. However, depending on your personal situation and preferences, there may also be other options out there that can accomplish that same goal, and depending on how far you're willing to go with them, it might even work better than the switch method. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.